This is the price action for Tuesday, the 8th of October. I'm going to be doing a review of NASDAQ. As you can see, I've got a whole bunch of annotations, which looks very complicated right now. I'll break it down on a clean chart and step by step. But there are just a lot of models and confluences that are very specific ones that I've got heaps of examples of and that I was able to find today. Part of those were the narrative using the regular trading hours and ETH chart. Also a market maker framework, so MMXM framework, where we have a first stage and second stage delivery, which I use a very specific entry model for, and I've got very specific entry criteria and break-even logic for that as well, which I've got mapped out here, which I'll walk through. And on top of that, there was another entry technique, which is the impulse failure swing, impulse rejection failure, which is essentially when you got a failure swing with impulse low, and then it gives you a really tight entry. With this particular example, the stop loss was slightly wider, using the standard model rules. But as you can see, it delivered really nicely, delivers down to Monday's midnight price, and I'll walk through why that was a very high probability draw as well. So I'm just going to jump over to a clean chart so I can make it a bit, walk you through step by step. Just to quickly get the context. Very bullish at all-time highs. We do have a daily bullish order block down here, which is very interesting to me. We might want to drop down into that area. And then you can see that Friday had this red closure day, meaning that going into the weekend, we created the sentiment of us being bearish, meaning that there's going to be a significant amount of buy side above the high. We then ran that out on Monday, closing bullishly, and then on Tuesday, taking that previous day high and finally having this drop back down into the range. If I go to the 1 hour chart, so on the 1 hour, this is the new week opening gap currently. So that's the weekly open, and you can see how we actually gapped up and traded straight upwards after having left these relative equal lows down here. So we know this is a significant amount of sell side below this low, and we immediately traded straight back up after that Friday sell-off. Then that's Thursday's previous day high, and then we sold off into the close. Go into the 15, start seeing a bit clearer of the picture. So there's that Sunday open running above that previous day high, that Friday's high. We then took the high out once again in the PM session, and then that starts selling off down into the close. And if I bring up the regular trading hour chart now on the same time frame on the right, we'll be able to compare the two and see how that looks going into the close. And there we go. So that's the price action from Thursday. So that's this price action right here. I need that price action here. That's all seen in this area. So we have that 9:30 sell-off, and then it made a new high on the day, and then rolled over into the close. And so that's where this becomes really interesting to me. We have this sell-off into the close, and what traders are going to see is that it's enticing shorts into the close. So anyone in the PM session, the last thing people see is that, oh, we're really bearish. We are making lower highs, and you'll notice that they're also very smooth highs, meaning there's a lot of trendline liquidity up there. Leaving smooth highs, we're breaking below this support level, so people are going to want to short below that, hitting all the sell sides, tripping in shorts, and now we know that there's going to be an enormous amount of buy side above all these highs, especially with this being a really obvious impulse high. That's a level I look for us to hit, and just us hitting this level, I wouldn't even require it to take out the previous day high. That's already significant enough. But you can see that we actually ended up running up there, consolidating and accumulating above all this buy side in the AM session. So if we draw out a box here, we can just imagine in this area, there's a lot of buy stops and breakout longs, and smart money was accumulating a net short position in that area. The next thing that lines up with that, so I'm actually going to jump over to the the 5-minute chart real quick, just so I can show a bit better what I'm looking at. So as I mentioned, there are a few different models that I wanted to go over, and it would be best if I do them one by one. So the first one I'm going to do is just the narrative using the RTH charts and the ETH charts that's talking about these boxes I've got here. So I'm actually going to steal these. So we paste these over here and I'll make them no sync. So the regular trading hour narrative was enticing shorts going into the close, and you can see that with this drop lower here. Enticing shorts going into the close, meaning that there's going to be a bunch of buy side up in this area. The electronic trading hours narrative is we're enticing longs into the open. You can see that with these large bullish runs higher. So everyone sees that, they think, wow, it's so bullish. Once again here, a really solid bullish run. We even have this bull flag that breaks out, and this is a really nice signature to look for ahead of the 9:30 open. If we have classic bullish patterns such as a bull flag playing out, it means that they're priming retail for a likely reversal. So if you have the confluence of bullish bull flag, that breaks out, and as well as we are hitting major liquidity levels such as this previous day high as well. And on top of that, we're leaving these impulse lows, so you know that they're trapped longs below this low. That's a very nice confluence for the short. So we have the electronic trading hours narrative of enticing longs. We have the narrative of trapped longs, and that's seen because with this big bullish run up, where are people going to put their sell stops to protect their position? Well, there's not a single swing low in this entire leg up. And then we have this aggressive pullback ahead of the open. It's pretty obvious to me that the nearest area for stops to reside is below this impulse low. And then obviously we've got a nice pull below the bull flag as well. So the fact that we hadn't hit this low ahead of the open means that I know that we've got trapped longs down here. We've got the RTH narrative enticing shorts, ETH enticing longs, and we're opening up above that buy side already. So that means that we're going to likely accumulate all that buy side and then attack the trapped longs below this low. So just a short from this area down to this low is very high probability. That kind of gives the framework overall, and now I can go from here and drop down to show the different various entry models. The first model I'll go over is actually seen on the 15-minute chart, which I'll bring up. And what this is a wick rejection failure. That's essentially, if I replay, I won't replay actually, but if you look at this area in here, if I zoom in a bit, you can see we engineer a very long wick right at the open. We then consolidate above that wick, and then we run it out on this candle. So usually if we take out a long wick and reject straight back up with another long wick, that's a very bullish signature. That should indicate that, okay, we rated this low, we had a really strong rejection straight back up, and that now it's likely to continue pushing higher. But because I'm bearish, I want to see that fail. And the best entries that you're ever going to find are when something that should happen doesn't. That is the most ideal entries. So you can see that long wick engineered on the 15-minute here. We then take it out and have a really nice rapid rejection straight back up. That should indicate extreme bullishness. The very next candle overlaps that aggressively straight back down. That is the entry signal as soon as we break this low. That becomes the signal to get in short. And the way that works the best to get in these moves is just to use the midpoint of that wick. So the 15-minute wick that fails to hold price above it. We then get below the low, break that low. You can just short at that candle here and put your stop loss simply above the order block. There are obviously ways you can make tighter stops, but I'm just using the most high time frame obvious swing point, that's a clear order block, and that would invalidate the trade. And yeah, that's essentially the model. So it looks something like that. And you can target down to the midnight price, which is around here somewhere. So that would be a nice target. And then also the Monday midnight price, which is all the way down here somewhere. Roughly here. So that's Monday midnight. When we have I'll talk through the Monday price now. So first of all, that is this entry technique. There is a nuance to it that I should really talk about really quick as well, that I actually only figured out this week. But as you can see, that this is clearly in a premium of the range. If you look at the high time frame dealing range, from this low up to the high, we never hit EQ, but then and at this point EQ is down here, and we're at a deep premium. We're also at a deep premium of these lower time frame dealing ranges. So that's very important if you're looking for this wick rejection failure entry technique. If I jump over to gold, this occurred on the same day, so also yesterday on the 1 hour chart, I believe. Here we go. So it was actually NASDAQ after all. For some reason thought it was gold, but no, it was on NASDAQ. So this is that example on the 15-minute chart from today. That's that 15-minute wick midpoint short. That's up here. But the example I was actually thinking of was just earlier that same day, and that's down here. You can see that we have the same pattern. One wick, a really long wick. The very next candle takes it out and rejects back up. And then straight after that, instead of continuing bullishly, it sells off again. And I was initially bullish, and I was trying to go long up here after we got the second rejection. But then it came straight back down, which I wasn't expecting, and that, to me, looks exactly like this model over here. It looks like this model where we've got a long wick, a wick that takes it out, and then overlap it. So when that happened, I suddenly switched my bias short, and I ended up shorting down at the lows here, which clearly didn't work out. So let's say I shorted at the midpoint of this 1 hour wick with a stop loss above the order block, and then gets taken out straight away. Missed this beautiful move that I was looking for this entire time. I wanted to go long, and got taken out. And what I figured out was the problem with this is, if you look at this range, are we in a premium or a discount here? If I'm going short with this particular model, over here I'm in a premium and it works. Over here, this is not in a premium at all. This is at a ultra deep discount. If I put on that long wick midpoint, that should be on, and you short from there, we're clearly shorting at a deep discount of the range. And this let me create a antithesis for this model. And I've got a playbook where I try and I find the opposite of my model so that I know exactly what it looks like when it doesn't work. So if this is the impulse rejection failure, a long wick that gets taken out and rejects, but then immediately fails and then gets short. This is the impulse rejection failure, which I've called the Triple Wick Flip, TWF. You've got one long wick, you run it out with a second long wick, and then it fails and comes straight back down. So that's normally, I'd see that as the long wick soup failing and for us to continue lower. But when we are at a deep discount, then it can oftentimes result in basically a 3-drive pattern. If you look at this, 1, 2, 3, and then a really nice move the opposite way. And I'll show that to you real quick. That's the antithesis playbook for that, where we have a regular impulse rejection failure at a premium of the range with trapped longs narrative, which we also have over here. We've got those trapped longs below this low. We've got one wick that gets rejected initially, and then it overlaps, and you can short that. And then the opposite, the antithesis, is the triple wick flip. Exact same kind of pattern, a long wick that's rejected by another long wick, which is here. And then price fails the rejection and overlaps right there. So the only difference between this point and this point here is that over here we're actually in a discount of the range, and this is just going for a third drive on the lows. And then when we get a closure back above that midpoint of that wick, that constitutes a long entry. So what that looks like over here is if we zoom in on this 15-minute chart, we can see that we actually closed back above that 1 hour wick midpoint, and let's say you just went long straight there with a stop loss wherever, and yeah, target the highs. So that will do for that particular thing. Now I'm going to look at the Monday midpoint as the Monday midnight price, sorry. The reason I've got it marked out is if we look over here, this yellow candle represents the 9:30 open. That's the RTH session. We never returned down to the midnight price during the regular trading hours. When this happens, I see it everything following that price being that we're being held at a premium until we reach this price again. And this could last weeks. Like, let's say you had a midnight price down here that we never reached, which I don't actually know if that's the case, but yeah, let's say there was a midnight price down there that we never reached. I'd see all of this as being held at a premium, and I'd continue drawing this out in the future until we reached it. I don't have a specific amount of time that it should be drawn out for, but if you backtest this, you'll find that whenever we fail to return to the midnight price during the RTH session, we end up returning to it eventually. And that made this a very high probability target. The next thing I'll go over are just the low time frame entries, and I'll try and finish this up nice and fast. So I'll delete everything we don't really need. Don't need that. Oh great, there's a bit of a glitch here. Just a candle missing, but it's all good. There's just a red candle there basically. So looking at this chart, obviously we've got the trapped longs below this low. We have the opening, we sold off ahead of the open, 9:30 makes this low and then trades back into the range. So this becomes a retracement because it didn't make a new high. This is not a continuation, this is a retracement to continue lower. When we have this starts a market maker model framework where we have the retracement. At the high of the retracement, that becomes the smart money reversal. And I'm going to put that in here as SMR. After the smart money reversal, we break the low. And sure, you could say, okay, we've got first stage of the market maker model here, and then we've got second stage. If you look at the 15-second charts, it's probably around here somewhere. And when you hit the low, that's the market maker model completed. You can say that on a fractal nature, but there's another dimension to the market maker model framework where we have the smart money reversal. Only after breaking the low that we retraced from do I look for first stage of the market maker model. First stage is when we retrace back up and then make a intermediate term high, and it becomes first stage. A lot of the time you'll have SMT on the first stage like that or something. We don't actually have that just here. It's pretty much the same. However, there is some really clean SMT with the smart money reversal up here. So we actually made SMT here. And I suppose you could call that first stage because ES has already broken its low when we came up to make this high. So that's probably the same kind of thing, but we do have SMT, just not on the first stage. After making first stage, we're looking for it to sell off and break the low again. Once it breaks the low, that means that first stage of the market maker model has been completed, and now we can start looking for second stage of the market maker model. And this is where it gets really interesting and a really nice entry model. And I can show you a whole bunch of examples I found just a few weeks ago as well. After breaking that low, that pullback to make first stage, we then are looking for second stage. And in second stage, we know that it should be a very fast move. It's likely institutional order flow entry drill, so a partial entry into fair value gap. Just going to fix this missing bar real quick. Once we break this low again, then you're looking for a fast move. I've got a very specific entry technique called the impulse rejection failure, and that technique is best used for second stage because it requires a fast moving market. So by identifying the second stage of the market maker model, I know that I can use this entry technique, which a lot of the time can give me an extremely tight entry. In this particular scenario, the entry wasn't super tight. However, with the move that followed, it still offered an enormous amount of R. How this entry model works, I'll do a really quick diagram, is we have that shouldn't be that color. We have an impulse low. So if we look for a bearish model, we have a really obvious low like this with an impulsive leg up. And what we're looking for is once we break that low, we want to see it attempt to reject back up and then fail to do so and then get a closure back below that same level. Once we get that, you can enter short and expect that continuation. And that's basically what I'm showing here is we have a impulse low, we break below it, we then get a closure back below right there, and then you're looking for a short. Now there are a few rules for it. And as you can see, we actually already closed back below it on this candle, or this candle right there. The reason why that one doesn't actually count is because it requires buy side delivery back above that level. What buy side delivery is when we move in an upwards direction, but it also has to have broken some sort of a swing high or low. Even if that's on a very low time frame, buy side delivery is only when we break a high or a low. So that's why all this is sell side delivery, except for this point right here where we delivered above this high. Otherwise, sell side delivery. And that's how you can determine fair value gaps and what ranges should hold price and what shouldn't. But the key is that it has to take out a high. And as you can see, this was the only swing high we have in this area. And we never broke above that high before closing back below this low. So at this point here, we still have only got sell side delivery. It's had a slight retracement, but it's still only sell side. It's only once we go back up and then break above a high that's back above this low that we've now successfully had buy side delivery in this direction. And now on the next closure back below the low, that becomes this entry over here, which looks like that. Hate how these always become so big. So that entry becomes down here, but I'm not entering like that because we just had this big move lower. It's very extended away from my ideal entry, which is at the low. And so I have a rule for that. The rule is that you find that closure, which is down here. I'm going to use this tool for it. But you find that closure, you then find the midpoint. So drag it up like this, between the impulse low and the entry signal, which is the close back below that low. And you just short from the midpoint between those 2 points because it doesn't always come back up to test that old low, as you can see. So that means that we'd get a nice entry right there. The stop loss is the standard placement for the stop loss is above the swing high from that first stage. And that's your entry right there. So signal is on that second closure. Entry is at the midpoint between the closure and the low, or as high as you can get it. And the break-even logic is after we've closed back below this low, we then count the breaks of the low. So this counts as the first break. So break one, and then we wait for that to make a new low. It does. And then you wait for that second low to get broken as well. Once that gets broken, you go to break even. And so as soon as price breaks this low there, you're at break even and you can just let it roll over like that. That's that model. There was one other. Oh, that's right. So the last one I want to talk about is extremely similar, and I can basically show it to you right here, all here. It's just the exact same as this, and the exact same entry. Everything's the same, but the idea is that it's a failure swing, an impulse failure swing. Is the framework. So where you have a failure swing, which just means that it fails to make a new high and then goes back down. And the low that made that failure swing is an impulse low. And what I mean by that is there's a singular swing point, which here there's kind of two, but it's still kind of one. A singular swing point that has an impulsive move up and then pulls back down and breaks that low. The idea is essentially that we've got trapped longs above that level. We have a really impulsive, enticing move up, and the only place for people to trail their stops if they're going to use a swing point is actually below that impulse low. We then break that low, close back below, short. You could say the exact same thing on the high time frame here, where if you look at the 5-minute chart, this is not a failure swing, but it's still an impulse low that has a single move up. Once we break that low, you'd want to see that reject price. It begins to reject, but then fails to do so, closes back below, and this isn't a model, one that I would have just taken like that, but theoretically, that is what the entry is an impulse low that fails to get hit, and then rejects, and then closes back below. So that's the impulse rejection failure, and this is a impulse failure swing to impulse rejection failure, which is a mouthful, but yeah. I'll show a few examples of this scenario really quick if I bring up a Notion. And continuation model second stage. This is today's one right there. Yesterday's one that I just broke down. We then have another example here where we have a retracement. Oops. So we've got a retracement that puts in a smart money reversal. We then break that low, so shift, retrace back into the range. That becomes first stage. We break the low successfully, but then we do not close back below it. So we're still in that first stage, and then pulls back up, but then we eventually get that closure back below the low, and then it sells off, and that second stage ended up reversing from there, as you'd expect in a market maker model. The reason why I've got such a tight stop on this is this is another variation and nuance of the model that I'm backtesting at the moment, where when we have a failure swing within after having broken an impulse low or impulse high, and then have a deep failure swing, but then get a closure back below, you use a fractal, even tighter way to manage risk. So that's still something I'm working on. We then have this earlier this day, so this area up here. Same thing, 9:30 opens, makes a low, clear retracement, puts in a smart money reversal, breaks the low, will come back up. This becomes first stage. As soon as it breaks that low, first stage is successfully delivered. Looking for second stage, which is a retracement, then a closure back below this low that pulled back from first stage. We get that closure right there. We're quite extended below it, so rather than getting short there, you wait for us to retrace to the midpoint, as you can see I've drawn out here. The midpoint between that closure and that low, and you just get short there. Another example, we make a low, we retrace, that becomes a smart money reversal, we break the low, first stage, we break that low again, and then retrace, close back below right there, second stage impulse rejection failure, short, that breaks the low once, below that initial low that's retraced, so one, and then it retraces back up and breaks the low a second time, and you go break even at that point, and as you can see it reversed. And this one, I think that's the same one, isn't it? No, it's different. Same thing, a retracement after selling off, puts in failure swing, so a smart money reversal. We break the low, retrace for first stage, we break back below that low. I use that as the most recent leg up, but it's exactly the same level as that anyway. We have a failure swing, and then close back below becomes the short, either there or at the midpoint, but you're so close. And then it sells off nicely. This one here, once again, 930 sells off, makes a low. We retrace, put in a reversal, consolidates, breaks the low, retraces, becomes the first stage. Once first stage breaks that low again, we're looking for second stage. We get that second closure back below right there. And technically you would just enter at that low, but I saw that we had the 20s just above, and I thought, well, you could, expect us to reach up to the 20s, but the thing is, it doesn't always do that. It might just roll over and remain super heavy. So it just happened to hit the 20s there. But yeah, it results, when it plays out, it results in a very nice extended move, especially if we've had this characteristic of the AM session, just consolidating and trapping people long, especially if there's a really major sell side pull just below us. It becomes really obvious that they're just wearing people out during the AM session. Everyone's buying, thinking that I've got support, and then it waits till lunch to have this nice rollover. That's what we'll do for this video and this review of yesterday's price action. Hopefully you took something away from it so that you're able to use in your trading, or at least see how I think about my frameworks. Sometimes they do feel a little bit too structured, like it can feel a bit overwhelming sometimes to come up with, like, okay, what is the regular trading hours and ETH narrative telling me ahead of the open? In some cases, it makes a lot of sense to me, such as it did today. I was very confident with it being a short. Sometimes that can just throw me off as well, so I do need to simplify my process to some extent. But yeah, hopefully you can take something away from this review.